December 18th, 2025. The Federal Reserve cuts interest rates by 25 basis points, the third consecutive cut this year. Federal funds rate now sits at 3.5% to 3.75%, down from 5.5% back in July. And silver? Silver exploded to an all-time record of 66,175 per ounce. Not inflation adjusted, actual nominal high. Higher than 1980, higher than 2011, higher than any price in 5,000 years of recorded silver history. But here's what happened next that should make you pay attention. On December 19th, after cooler than expected inflation data showed core CPI rising at the slowest year-over-year pace since early 2021, silver consolidated near $67.15 per ounce. That's right, $67. And markets are now pricing in 2 more rate cuts in 2026, with Fed Governor Christopher Waller, a leading contender for Fed chair, openly calling for borrowing costs to drop another percentage point. This wasn't the reaction to one rate cut. This was the culmination of a mechanism that's been building all year. Because rate cuts don't just make silver attractive, they trigger an elasticity cascade that magnifies moves in ways most people completely miss. And central banks, while focused on employment targets and cooling inflation, are accidentally creating the perfect storm for silver to push toward $80, maybe even $100 in 2026. Not through speculation, through mechanics, cold mathematical mechanics that unfold whether anyone intends them to or not. Let me show you exactly how rate cuts translate into silver price acceleration, why the elasticity mechanism means small inputs create massive outputs, what $80 silver actually looks like based on current trajectories, and why 2026 might be the year this all converges. Because if you understand the machine, you can see where it's going. And right now, the machine is pointing straight up. First, let's understand what happened on December 18th, not the surface story, the actual mechanics. The Federal Open Market Committee voted 9-3 to lower the benchmark federal funds rate by a quarter point. But here's the twist. While the Fed delivered the expected cut, it subtly altered the wording of its statement, suggesting greater uncertainty about when it might cut rates again. This was supposed to be hawkish, supposed to cap silver's rally. Instead, silver surged 3.8% to hit $66,175. Why? Because the bond market and dollar told a different story than the Fed's words. Treasury yields fell, the dollar weakened. And Bloomberg's chief U.S. economist Anna Wong called the overall tone of the statement and updated projections as leaning dovish. Translation: the Fed is cutting and they'll keep cutting despite the careful language. Markets don't believe the pause narrative. They're pricing in January 2026, having a 25% chance of another cut, in April 2026 being almost fully priced for one. And when the Fed lowers interest rates, they're reducing the opportunity cost of holding non-yielding assets. Silver pays no dividend, no interest, no cash flow. So when risk-free Treasury yields are at 5%, holding silver means you're giving up that 5% annual return. But when Treasury yields drop to 3.5%, the opportunity cost shrinks. Suddenly, silver becomes relatively more attractive because you're sacrificing less yield to hold it. This is the first order effect. Lower rates make silver competitive with bonds, and with unemployment climbing to 4.6%, the highest since 2021, with payroll growth slowing near zero. Fed Governor Waller is openly warning that job growth has slowed to near zero and called for measured rate cuts next year to help support employment. But wait, you might ask, doesn't this sound backwards? If the economy is weakening, won't that hurt silver? Great question. And this is where it gets fascinating, because there's a second order effect that amplifies everything, the dollar. Rate cuts weaken the dollar. When U.S. interest rates fall, foreign investors get less return on dollar-denominated assets. This reduces demand for dollars. Lower demand means lower dollar value. And silver is priced in dollars globally. Here's the math. After the December 18th rate cut, the Bloomberg Dollar Spot Index fell. Not massively, but consistently. And when the dollar weakens 5% and silver is at $66 per ounce, that same ounce becomes 5% more expensive in dollar terms just to maintain purchasing power equivalents in other currencies. So silver might rise to $69.30 purely from dollar weakness. This isn't speculation. This is currency adjustment. And oh wait, you're thinking, but doesn't dollar weakness help everything priced in dollars? Why is silver special? Brilliant question. Because silver has something most commodities don't: inelastic supply. Let me show you what inelasticity means and why it creates the launchpad for massive price moves. Elasticity measures how responsive supply is to price changes. If oil prices double, oil companies drill more. Supply increases. That's elastic supply. But silver? 72% of silver is mined as a byproduct of copper, lead, and zinc operations according to industry data. Mining companies don't mine for silver. They mine for base metals. Silver just tags along. This creates a bizarre dynamic. Silver has risen from $29 in January 2025 to $67 in December, more than doubling in value, a 130% gain year to date. But mine supply barely responded. Because mining companies make production decisions based on copper prices, not silver. If copper is at $4 per pound and profitable, they mine copper. The silver that comes with it is a bonus, but they're not opening new mines or expanding production just because silver doubled. Data confirms this. Silver mine production has been flat or declining for years, despite prices surging. Global mine output sits around 830 million to 845 million ounces annually. It's not growing. Meanwhile, demand hit 1.2 billion ounces in 2025, according to Silver Institute projections. That's a 175 million ounce deficit after accounting for recycling. Supply can't expand to meet demand because supply is structurally constrained by base metal economics. This inelasticity is critical because when demand increases and supply can't respond, the only variable that adjusts is price, dramatically. Now add rate cuts to this equation. Rate cuts stimulate economic activity. Manufacturing picks up, construction increases, technology production expands. All of these sectors consume silver. Solar panels, electronics, electric vehicles, 5G infrastructure, AI data centers. Every one of these industries is silver intensive. Industrial silver demand is expected to remain elevated in 2026, particularly from what analysts are calling inelastic sectors like solar, EVs, and data centers. When you're building a $2 billion AI data center and silver goes from $30 to $67, so here's the cascade. Rate cuts stimulate economy. Economic activity increases industrial demand for silver. Supply can't respond because it's byproduct constrained. Prices must rise to ration demand. This is the elasticity mechanism. Small rate changes trigger large demand increases, but zero supply increases, forcing massive price adjustments. And we're watching this unfold in real time. November 2025, ETF inflows surged. 15.7 million ounces added to silver-backed ETFs in 1 month, according to Bloomberg data. Institutional buyers allocating to silver because rate cut expectations make it attractive relative to bonds. This is investment demand layered on top of already stretched industrial demand. December 2025, physical inventories continue draining. Shanghai silver inventories hit multi-year lows under 600 tons. London's LBMA free float sits around 155 million ounces, barely 1 week's global demand. COMEX registered inventory at 113 million ounces, against open interest representing 650 million to 900 million ounces. Everywhere you look, physical silver is disappearing while paper claims multiply. This is classic setup for a squeeze, not a speculative squeeze, a structural squeeze driven by fundamental supply-demand imbalance amplified by monetary policy. And here's where the $80 target becomes mathematically reasonable. Not guaranteed, but reasonable. Silver started 2025 around $29. It's currently at $67. That's a 130% gain in 12 months. Now, can it rise another 19% to $80 in 2026? Let's look at the math. The gold to silver ratio currently sits around 65.0 to 1 according to recent COMEX data from December 19th. Gold at $4,087, silver at $67.49. Historically, this ratio averages 60 to 1. During bull markets, it compresses toward 50 to 1 or lower. If gold stays at 4,387 and the ratio compresses to 60, silver goes to 73.12. If the ratio hits 55, silver reaches 79.76. At 50 to 1, silver is at 87.74. And gold isn't standing still. Multiple forecasts project gold at $4,500 to $5,000 by end of 2026. If gold hits $4,600 and the ratio is 60, silver is $76.67. If the ratio compresses to 55, silver is 83.64. These aren't wild speculations. These are arithmetic outcomes of historical ratio relationships combined with analyst forecasts already on record. RJO Futures senior market strategist Bob Habercorn stated directly, we could see silver trade over $70 an ounce in the first half of 2026. Wisdom Tree's Nitish Shah told Reuters that silver prices could get close to $75 by the end of next year, citing supportive conditions tied to inventories and broader fundamentals. These institutions employ teams of economists, commodity analysts, and quantitative modelers. They're not throwing darts, they're running supply-demand models, incorporating rate cut impacts, factoring industrial demand forecasts, and concluding that $70 to $75 silver in 2026 is within probability bands. And frankly, after watching silver break every resistance level in 2025, dismissing $80 seems more dangerous than preparing for it. Now, let me show you the timing because Rate cuts don't affect silver instantaneously. There's a lag. And understanding the lag is how you position before the move. Typically, silver responds to rate cuts in phases. Phase 1 is immediate, the announcement day, December 18th, 2025. Silver spiked 3.8% on the cut itself. This is the reflexive move, traders buying on the news. This phase delivered us to record highs above $66. Phase 2 is the sustained response. This takes 3 to 6 months. As lower rates filter through the economy, economic activity picks up. Industrial demand increases. Investment demand grows as more capital shifts from bonds to alternatives. ETF inflows sustain. Physical buying accelerates. This phase is where the real move happens, not overnight. Gradually, then suddenly. Phase 3 is the acceleration. This is when supply constraints become undeniable. When Shanghai inventories hit zero, when COMEX faces delivery demands it can't fulfill, when lease rates spike to 20%, when physical dealers can't source metal at any reasonable timeline, this is when prices gap. $70 becomes $80, becomes $90 in weeks. We're currently entering phase 2. The rate cuts happened. The immediate response occurred, pushing silver to all-time highs. Now we're entering the sustained response. Industrial activity is expected to pick up as lower borrowing costs take effect. ETF inflows are accelerating. Physical tightness is becoming more visible, with Shanghai at decade lows. And if Fed delivers additional cuts in 2026, which is increasingly expected despite their cautious language, each cut adds fuel, compounds the effect, reinforces the mechanism. Here's what keeps me up at night, though, because this isn't just bullish mechanics. There are risks that could derail everything. First, inflation resurgence. If inflation reaccelerates, Fed might pause or even reverse cuts. Higher rates would strengthen the dollar, increase opportunity cost of holding silver, and potentially crash prices. Core PCE was at 2.8% in recent data, still above the 2% target. If it rises to 3.5% or 4%, rate cut bets evaporate. Silver corrects hard. Second, demand destruction. If rate cuts aren't enough to stimulate growth, if recession hits despite easing, industrial silver demand could collapse. Solar installations might slow, EV production might pause, data center build-out might delay. Demand falling 20% would overwhelm supply tightness. Prices fall despite deficits. Third, profit-taking cascade. After a 138% gain in 2025, silver is stretched, technically overbought. Sentiment approaching euphoric levels. If large holders decide to lock in gains, they're selling triggers algorithmic stop losses, forces margin liquidation, and creates a 30% correction in days. Silver at $67 could flash crash to $47 before recovering. These risks are real. Anyone ignoring them is setting themselves up for pain. But here's the counterpoint. Rate cuts in an inelastic supply environment with structural deficits and rising industrial demand create a probabilistic skew. The odds favor higher prices more than lower prices. Not certainty. Odds. And when you're playing odds, you don't need to be right 100% of the time. You just need the expected value to tilt in your favor. So where does this leave us? December 19th, 2025. Rate cuts delivered. Markets pricing in 2 more cuts in 2026. Supply constrained by byproduct structure. Demand rising from industrial and investment sources simultaneously. Inventories depleting globally. Physical tightness visible. ETF inflows accelerating. Gold to silver ratio compressing. The elasticity mechanism is engaged. Each rate cut reduces opportunity cost, weakens the dollar, stimulates demand, but supply can't respond. Prices adjust upward to ration limited metal. This isn't speculation. This is economics. And the targets that seemed aggressive 6 months ago, $70, $80, even those being discussed seriously by major analysts, they're now being framed not as moonshots, but as scenarios within the distribution of probable outcomes. My take? $80 silver in 2026 is reasonable if the following conditions hold. Fed delivers at least 1 more cut. Dollar remains weak or weakens further. Industrial demand continues growing at projected rates, and physical supply tightness persists or worsens. If all 4 hold, $80 is conservative. If only 3 hold, $70 to $75 is likely. If 2 or fewer, we might consolidate around $60 to $70. And if none hold, if inflation surges and Fed pivots hawkish, we're back to $50 with a 25% correction shocking everyone. But central banks don't cut rates unless they're confident inflation is controlled and economy needs support. They already started cutting. Reversing would require significant new data. Absent that, the path of least resistance is continued easing through 2026, and every additional cut feeds the mechanism. Reduces opportunity cost, weakens dollar, stimulates demand, but supply still can't respond. Inelasticity means prices must rise. It's not a choice. It's a requirement to balance the equation. So yes, rate cuts equal silver moon. Not because of hype, because of mechanics. Cold, indifferent mechanics that don't care about sentiment or hope. They just execute based on input variables. And right now, the input variables are screaming upward pressure. The machine is running. Central banks are feeding it with rate cuts. Inelastic supply ensures it can't be stopped by production increases. Industrial demand ensures it can't be stopped by weak economic activity. And physical tightness ensures that when the system breaks, it breaks upward violently. $80 silver in 2026 isn't guaranteed. But after December 18th's record high of 66,175, after December 19th's consolidation at 67.40, after Fed officials openly calling for another percentage point of cuts, after unemployment hitting 4.6% forcing their hand, $80 is becoming the base case. And anyone not positioned for that possibility might be the one left wondering what happened when silver gaps from 70 to 95 in 3 weeks, because COMEX can't deliver and Shanghai has nothing left. The rate cuts happened, the mechanism is engaged, and 2026 is when we find out if central banks accidentally created the perfect storm. Because they weren't trying to pump silver, they were trying to save the economy and support the labor market. But when you cut rates in an environment with inelastic supply and rising demand, you don't just stimulate growth, you launch the metal to the moon.